And that 20% jump in Tesla now is one of the reasons for the rally in the Mag 7 today. But my next guest has been pulling back dramatically on his positions there, moving money into other areas of the market like value. He reduced his tech exposure by more than half this month due to the election, geopolitical, and debt cycle risk, and is the most hedged he's been all year. James Cakmak is here. He's Chief Investment Officer at Clockwise Capital. We had to play this up, James, because we all remember your big Amazon call a couple of years ago. Did it meet objectives or no?
Yes, Amazon met objectives, but you have to adapt to the dominant market cycle at play. We were probably the longest we were all year about a month ago. Predicting a 50 basis point cut from the Fed. But after that move happened, it's like, where do you find the value and where do you go with that money? A lot of those stocks had run, the tech companies, the big megacap companies had run. So we were looking for alternative areas to deliver alpha between now and the end of the year. Looking into areas like value, we had added a position like in General Motors, for example. Looking at the metals, we like Alcoa, Freeport, U.S. Steel. And looking at these smaller cloud services providers that had, and software companies that had kind of been left for dead, like companies like GitLab, Nutanix, that we added to. So really, it's about taking from those mega cap names, putting them into value, and putting into underappreciated software names, while keeping our semiconductor exposure on.
What kind of market is this? If you're getting out of the Mag 7, the big platform names that made so much money over the years, and you're going into GM, and I know they had decent earnings the other day, but what do you think is really going on here?
There's just a lot of uncertainty. When you have predictability and certainty in the market, you can lean into the tech cycle. Obviously, we're innovation biased. That's where we want to be. All else equal, that's where all our money will go. But we have unprecedented times right now, uncertainty with the election, what's happening with the Fed's balance sheet, and obviously geopolitical. So there's too many unknowns right now to lean in a concentrated, overweight way in those names. Now, we're still there in those names. We're still in Amazon. We're still in Microsoft, for example, but we like the more secular winners. Our top weights now have gone from the Mag 7, the Palantir, Robinhood, and Spotify. We think that there's more upside in those names, and those are now our top weights, and we're rotating from those mega cap into value and a smaller cap.
Yeah, but a lot of people would still say secular winners are the Mag 7.
Yes, they are. But at what price do you pay them? And what is the opportunity cost of holding those positions over others? Because my job is to deliver alpha as much as possible above the market on a consistent basis. We're up 35% this year, over 50% greater than the S&P. We have to protect those gains. We have to stay vigilant and be tactical where we can. And right now, we're just exercising more caution. Just given the degree of unknowns, the markets are at all-time highs. Where is that alpha going to come from? And we don't think it's going to necessarily come from the mega cap names.
And tell me how you're thinking through inflation, James, which is a different story now than it was a couple of months ago. It's been a little stickier. A lot of people trying to figure out different ways to maybe play that narrative the best if they think that is going to persist. And you have some exposure here. You're looking to U.S. Steel, to Alcoa, Freeport, McMoran. Just, why not just say my inflation hedge is gold, or my inflation hedge is, something. I mean, we saw what happened with the miners today.
Yeah, I mean, we like gold as well. In addition, anything metal, we kind of throw into the portfolio. We don't think we're away from the inflation narrative yet completely. There's still uncertainty as to also what's going to happen with the Fed. The Fed funds futures continue to tick lower in terms of the pace of rate cuts. We were supposed to have 75 basis point cuts in November and December a month ago. Now that's down to 50 basis point cuts. So the economy is proving more resilient than not. So we want to keep that inflation hedge on, and because at the same time we don't know the pace of rate cuts from the Fed, and we'd rather be cautious than not.
Last question: why are the semis an area where you're sticking with some relative kind of overexposure here?
Sure. I mean, that's the mother of all secular themes. I mean, the world is only going in one direction. It's going to be increased automation, increased improvements in productivity across the board, and increased opportunity for abundance across the economy and society. So semiconductors will exhibit more volatility, but we think you have to be there. Now, we have trimmed, for example, NVIDIA was our biggest position, but we have trimmed that back, above 140. So it's more about keeping the exposure there, but flattening out, just keeping less concentrated weights and spreading them out across a number of names.
I cannot wait to check back in 6 months, 12 months, whenever, and see how this worked out, because it's a hard thing for a lot of people to do, to kind of walk away from the Mag 7. Even with some of them like Microsoft not actually doing that well this year, it still feels scary, and I'm curious if this switch will work. James, thanks for joining us to talk about it. Really appreciate it today.
Thank you.
James Cakmak with Clockwise Capital.